When we initially created this investment strategy, we were really trying to address what we thought is a hole in many advisors' practice. And that is, many people believe that they should be tactical and make shifts to their asset allocation over time. But the fact is, it's very hard to actually implement. I mean, it's obviously very hard to be correct, in where the market's going. But it's also hard administratively if you're running, 50, 100, 120 households to make those kind of changes in a timeless fashion, and also without incurring too much tax or transaction costs. And we really wanted to develop a tactical strategy that could be attached or bolted onto the side of a portfolio and provide that tactical component. In much of our modern history of investing, it's been simply just to buy and hold. Like, that has been the approach. Find out your appropriate asset allocation, set it and forget it, populate it with some quality products, quality managers, and you're good to go. However, markets change over time. And I think what's happening now is markets are becoming faster. The technology's changed, the participants have changed, and this faster markets are leading to bigger swings, both up and down. And that lends itself to a more tactical approach. One other aspect that lends itself to being tactical is it is getting harder and harder to find true strategies that are going to be a defensive volatility management component of your portfolio. There was a time when you could just go out and buy a good quality bond that had a bit of an income attached to it, and it would provide that stabilizer for your portfolio. But in today's world, with yields so low, investors have been forced to sort of sacrifice the defensive characteristics in search for income. And while we're not addressing that with our tactical strategy, what we're trying to do is provide a true defensive strategy that also has a reasonable amount of upmarket participation. Bond yields are really low right now. Valuations, even coming out of this bear market recession, are also quite high, which means that return expectations are not great if you look out sort of 3, 5, 10 years. And that's a lot of it has to do with the starting point of where things are today. And in a lower return environment, being tactical is much easier to add value than if everything's just trending higher. And because of those reasons, we think people should be increasingly adopting a bit more of a tactical approach for their portfolios. So we've been managing the Purpose Tactical Asset Allocation Strategy for 5 years now. And clearly the last 5 years have been rather eventful. And I think one of the true lessons that continues to reinforce our philosophy and approach is having a rules-based strategy can be very powerful in removing a lot of the emotion out of making decisions. When the markets began to sell off into the bear market in February and March, our strategy and our signals were very quick to react, and we got defensive very quickly by the end of February. And that really enabled us to hold on to a lot of our value. But it worked the other way too. We actually started re-adding to equity and moving out of bonds at the end of March. The rules-based approach is a very strong diversification tool as well. The Purpose Tactical Asset Allocation Fund is part of the tactical balance category, which is a basket of balanced funds that can really change their asset mix over time. Well, we do believe return expectations have come down, and we're probably moving into a lower return environment. We're also moving into a period that is likely going to have continued big market swings. Bond yields are really low. Monetary policy has been pushed to unprecedented levels, and the longer term implications on asset prices, I think, have yet to be absorbed. And not saying it's a negative thing, but we could certainly continue to see big swings up and down. And that kind of environment lends itself to more of a tactical strategy. It certainly does not lend itself to having a static 60-40 or 50-50 or 70% equity, 30% bond allocation and sort of setting it and forgetting it. And that's one of the trends that we do believe is going to continue over the next 3, 5, 10 years.